So it really is this simple. If you're trying to outperform 99% of startups in their seed rounds, you can't be doing what everyone else is doing. Think about it like the definition of insanity, doing the same thing over and over and again, expecting a different result. Apply that to founders of new startups. 90+% of startups, they end up failing. But for many of the startups that we've worked with to help crush their funding goals, we've seen nearly a 79% success rate. So in this video, I'll share the secrets behind our process for helping startups absolutely crush their seed round and the methods that you can use to get ahead of 90% of startups while avoiding mistakes that those 99% of the people are going to make. If you want extreme success, there are 3 traits you absolutely need. Number 1 is contrarian idea. Now that idea needs to be correct, so keep that in mind, and you need to execute massively. Execution is actually overrated. Think about this. If you just execute a bad idea, you fail faster. What matters more is being contrarian, different from the crowd, but also correct. And think about it like this. When you're pitching investors, if you sound like every other founder in your category to investors that see thousands of pitch decks a month, you're done. But when you're contrarian and correct, you immediately stand out to them. You no longer are fighting with the 99% of the crowd and the noise. So let me give you 3 real examples of startups we worked with who have applied this contrarian thinking. So EdTech startup, education technology startup, they looked like every other future of learning pitch. We reframed them around student outcomes and adaptive algorithm. The result, $1.4 million raised from angels and education-focused family offices. The other one, health tech company, they were targeting investors blindly, zero differentiation. We aligned their raise with QSBS and Opportunity Zone tax strategies. Result, $2.6 million raise in just 4 months. And the final example I want to give you is a consumer brand. They were way too early. No traction, no MVP. Instead of pitching, we told them just to pause, build pre-sales, and launch a viral waitlist. Contrarian thinking. Within 30 days, they had $300,000 in commitments and then raised $1 million immediately thereafter. Notice the pattern? Each one zigged where the others zagged. 99% of these other founders, they're going in this direction. These guys went the other direction. They weren't just different, they were correct contrarians. Each of these case studies follows the same format: problem, contrarian move, and a concrete result. And these aren't random success stories. They're a pattern recognition tool that helps you identify what actually works in your specific context. The founders who build and use this board raise more efficiently because they're applying battle-tested approaches rather than reinventing the wheel. You build this, and you're already way ahead of 99% of every other founder that's walking into investor meetings. This is the part most videos skip, but I'm going to show you the exact tools you should create to get ahead of 99% of founders and give you the most advantageous step in the right direction with these guys that you're going to need. Okay, here's what I call the Contrarian Audit Worksheet. 3 columns, very simple. Contrarian idea, proof it's correct, and execution credibility, as you can see here on the screen. Let's do one together. Airbnb idea, renting homes to strangers. That was the contrarian idea. Proof it was correct, the rise of the sharing economy. And just as a side note to that, I don't know if you remember couch surfing, but the MVP for Airbnb was couch surfing. Couch surfing was this app that you go on the app and you ask to stay on someone's couch. I mean, it was incredible. I did it a lot when I was in my early business days because it was cool. Airbnb didn't have to prove their model because couch surfing proved their MVP for them. And execution credibility, a scrappy founding team that proved traction early. Again, with couch surfing already up and running, doing great, that was all they needed. Do this for your startup and you'll immediately see where your pitch stands out or where it's weak. Next is the Fundability Dashboard. This is your investor-facing scoreboard. It tracks 4 categories: traction metrics, social proof, investor hooks, and milestones. Example, 1,200 person waitlist signups. That was their metric. Down here you see press mentions, first enterprise client. These little wins are proof points that make investors lean in. Think of this as your fundraising command center, a single source of truth for everyone and everything an investor needs to evaluate your startup. So instead of fumbling through emails for metrics when an investor asks, you instantly share this dashboard showing your traction, social proof, key financial hooks, milestone progression. I mean, the most successful founders I've worked with update this weekly and share the latest version in every investor follow-up. This is critical. It's dumb little things like this that really make the difference. It demonstrates organization, transparency, and a metrics-driven approach that instantly separates you from 99% of the noise and those founders who present scattered data points. Okay, let's talk about the CRM tracker, the Investor CRM Tracker. Most founders raise chaotically. Spray and pray. We've heard this a million times. This Investor CRM solves that. Each investor has a row, their fund focus, their check size, their status. You can see here on screen. Last touch point, objections. So here's an example. Name of the investor, XYZ. Fund focus, they focus on SaaS. Check size, 250. I'd put a range there, 250 to maybe 10 million. Any notes you have on there, you never lose track and you raise like a pro. This is your fundraising lifeline. Most founders track investor conversations in their inbox, which is why they miss crucial follow-ups and lose momentum. With this, purpose-built CRM changes the game completely. This shows your hottest prospects, the detailed notes capturing specific investor requests, and the structured pipeline that ensures nothing falls through the cracks. You're going to need this. Founders who implement this system typically close rounds 30% faster because they're managing relationships systematically rather than haphazardly. If you build nothing else from today's workshop, please build this. Okay, this is the investor teaser one-pager. Very important. Think of this as your movie trailer. Investors don't want your full 7 to 15-page slide deck at first. They just don't. They want, what do you do? How big is your market? What traction do you have? Who's the team? This one-pager is what gets you the meetings. The long deck comes after. These are really important for many reasons. This is your startup's front door, the first impression that determines whether investors dig deeper or move on. Because remember, these investors have seconds to decide if they want to hear more about what you've got or not. The most successful founders I've worked with use this document religiously, daily, attaching it to every cold email outreach and follow-up email as a PDF. The magic is in the constraints. You don't want to just spew and vomit everything. It's one page. You distill your message to its most powerful essence. Notice the balanced layout, the emphasis on metrics rather than claims, and the professional design that signals competence before a single word is even read. This document alone has doubled response rates for founders I've mentored, so keep this in mind. Visual identity, you want to keep it clean, nice, crisp. Market opportunity, you want to talk about traction highlights, you want to talk about team credibility, and you want to talk about clear call to action. Obviously, a way to connect with you, website, phone, email, what have you. Let's take a look at some examples. I'm going to move the overhead camera so you can see 3 examples of one-pagers, and you tell me if they're good or not. Let's take a look. What does a one-pager have on it? It has the highlights of the investment. It has who they are, what the story is, very briefly, very tight, very succinct. This one in particular has some highlights: targeted pre-tax IRR, contact information, a phone number, a website, LinkedIn. This is another one-pager, as you can see here. Very graphically inclined. I love that. These can be emailed out as a PDF, okay? Strong global demand, core location unit economics, talks about the revenue, 6 to 8 million, EBITDA 35 to 40%. Here's some traction, here's some sediments, US expansion history, and how to contact the head honcho right here. Always really important. And final one I'll show you, this one great, why invest with these guys? World-class resort, momentum in the $500 million downtown expansion zone. Here's the core team. Here's the way to contact them with an email and a phone number and a website. Why invest? Investment highlights. Fantastic. This is all you need. Welcome to the one-page world. This is going to be where you want to live initially. Now, finally, your event strategy map. Capital doesn't live on LinkedIn. It lives offline. You can create a mock-up with 3 events blocked out. I just did it here in this little gamma, but basically you'll see the Family Office Investor Summit, an Angel Health Tech Conference, and a local VC meetup. You can literally put these on your calendar, show up at just 3 events like this in a quarter, and you'll meet more serious investors than most founders ever will. So with all that said, when you're trying to get investors to give you funding, your pitch deck will be a big part of that process, obviously. But almost every founder I see completely messes theirs up. I've looked at and audited more pitch decks than I care to even remember. And I noticed a few consistent but detrimental problems that almost everyone made. So click here to check out the next video where I actually break down some pitch decks that made the exact same mistakes I'm willing to bet you are also making. And in that one, I show you what not to do, and then I give you a bit of expert advice on what you should be doing instead to make better pitch decks. So I will see you over there.